Hello, everybody. Welcome back to this is Bitcoin and Markets and Rogue Macro. You guys can follow me both channels on YouTube and both accounts on Twitter. Rogue Macro is obviously focused more on the macro side of the house, and then Bitcoin and Markets is more Bitcoin focused. But I like this is one of the big events that we go through on I guess, a 6-week basis where we get the FOMC drop. So we're going to watch this together and react to this together. Check out the websites, bitcoinandmarkets.com and roguemacro.substack.com. All right. So this is the FOMC calendar. You can find this by just Googling FOMC calendar. And we have all the meetings here. We are expecting an SEP to drop along with this announcement of the Fed cut, and it is out. So let's click into it. Support of our goals, the committee has decided to lower the target range of Fed funds by a quarter percentage point to 3.5 to 3.75%. So they have cut by 25 basis points. As expected, if we go over to CME, it's probably not going to load now, but it was at 90% for December. You can see. So this was a little bit less of a certainty by the market, but still what was being priced in was this 25 basis point cut. And the Fed has not disappointed. Let's take a look at some of these other meetings. So, the Fed funds futures, where they're priced at, gives us this understanding of what kind of cut is being priced into the market. So we can look at by the next meeting, but this contract, ZQF6, it expires 30 January. What's being priced in? Well, here, this is no cut. Okay. So this is no cut, 70% in January and a 21% chance of a cut. If we go out to the March meeting, we start getting 50% of no cut, but possibility here of 3 cut or 2 cuts in the next 2 meetings. April, that possibility goes under 300 basis points or 3%. And I was looking earlier at by the end of next year, what's being priced in. So here, this is the current range right over here, 9.5% of no cuts in 2026. And it looks like anywhere between 1 and 3 cuts is the majority opinion of the market right here, landing at 2 cuts in 2026 at the highest percentage. But of course, this changes on a day-to-day basis, week to week. So next week, this could be way different, but this is exactly what the market is pricing in right now. Okay, let's go back to the FOMC and we're going to read through this. And if we stay on, you guys can put a chat. Oh, wait. Damn. Sorry, Telegram. I wasn't sharing my screen. Let me do that now. You guys can put comments in the chat, both on Telegram or on YouTube. I should get those over here on my back end. And let's see if we have anything coming up. Okay, Green, sorry about that, man. I corrected it. So what I was showing for Telegram people, let's see if you're seeing this now. Okay, so I was showing this screen. This is December of next year, what the odds are looking like now. And if we go to January, we can see this is no cut. This is where we're at currently. This current range is now old. March, it starts spreading out to the downside. You can see that. And then all the way to December of next year, we have a big distribution here. But somewhere between 1 and 3 cuts is what the market is pricing in. We will see what the SEP says and go from there. Okay, so let's read some of this. We will try to hold on and listen to Powell's speech. But guys, make sure you are subscribed. If you're watching this on Twitter, follow, like, retweet, and check out the YouTube and the websites. Okay, all those links should be in the bio. Okay, available indicators suggest that economic activity has been expanding at a moderate pace. This is true. GDP is burning at around 4%. Let's pull this up. GDP now. And this is put out by the Atlanta Fed. This is their estimator. Their last is 3.5%, but you can see this has sharply fallen just in the last week, pretty much. With the last update, it was hovering at or above 4% for a very long time. But yeah, GDP. So when the Fed says that expanding at a moderate pace, that is true. I would even say it's a good pace. It's not even a moderate pace. But of course, we know we've talked about this a lot here on the show. Half of that is capex for data centers and AI. Half. So really, we're under 2% if you take out AI and data centers. How much return on investment will that have? That remains to be seen. I'm bearish on that return on investment from this AI build out. Um, but I think the bubble can keep going. So I've written about this many times. I think that the bubble can continue. It can get bigger than anybody can imagine. Everybody thinks it's so big right now, but it can get a lot bigger. I don't see when I went through and looked at individual stocks in this sector. You can't look at private equity, but you can look at the public equities, and you can see how they're doing on a monthly basis on the chart. Are they overheated? Does it look like the end of a bubble? And it didn't. I mean, we could still go for another 6 to 12 months in this bubble before we pop the. But I think eventually the AI bubble will pop. It's just a matter of when it happens. And we have to be honest moving forward. I don't want to be like this constant person that keeps saying, it's going to pop, it's going to pop, it's going to pop, it's going to pop, because you can be wrong for 3 years, 5 years, 10 years. Finally, it pops. You were right, but you should have been saying the whole time, I don't see this popping yet, but it will pop eventually. So, see, there's a big difference there. I think we have room to go on the AI bubble. So, expanding at a moderate pace, yes, that is correct, I would say. Job gains have slowed this year. Yeah, the SOM rule really has not taken off. Let's look that up as well. And guys, if you like this kind of analysis, make sure you're following and liking the stream. Let's go into Fred SOM rule. They actually track this on Fred, and you can see what this says is um it's something about like the 3 month. Well, what does it say here? SOM rule indicator signals the start of recession when the 3 month moving average of the national unemployment rate rises by half a percentage point or more relative to the minimum of the 3 month moving average of the previous 12 months. So anytime this starts taking off right here is when we have a recession. And you can see it's 100%. It was 100% until now. Look what happened here. It rose, it triggered the SOM rule, but then it has come back down. So, very interesting, weird times out there in macro. All right, that's the SOM rule. Let's go back to FOMC. So, job gains have slowed this year. Yes, I would say that they have been pretty bad actually this year. The unemployment rate has edged up through September. More recently, indicators are consistent with these developments. So, of course, we had the government shutdown, so we didn't get a lot of September and October numbers. They're still canceling releases of like PPI. This month was canceled. So some of these the knock-on effects of the government shutdown, the longest government shutdown in history, is we're still being felt by markets, and they're kind of nodding to this by saying through September. More recent indicators are consistent with these developments. Inflation has moved up since earlier in the year and remains somewhat elevated. Depends on what you think of as inflation. So let's go to Trueflation. I think this is one of the better developments in um, measuring of prices over the last probably 20 years or so. And let's see, how do we pick the US? Uh, no, that's not what we want. I just want a basic US measurement. Here we go. 2.5%. You can see middle of the year, it was down at 1.5. This is a real-time indicator. They do real-time prices, and it's not like every month on a survey. It's not even imputed like a lot of the stuff is in CPI and PCE. These are real prices out there in the economy, and we're sitting about 2.5%. But you can see the end of last year, it was up at 3%. Now we're at 2.5%, and we'll probably see that start coming down as well there. So back to the FOMC. When they say inflation has moved up since earlier in the year, that is correct, and it remains somewhat elevated. If their target is a symmetric 2%, symmetric, remember, that means if the inflation rate is quote unquote inflation. Okay, these we're talking about prices. We're not talking about actual inflation. Actual inflation is supply of money, but um, the prices that they call inflation, uh, it's a symmetric target. So if it's under 2%, they're supposed to become more accommodative and try to raise it to 2%. They don't want it to be at 1%. They want it to be at 2%. And so if it's over that, over 2%, then they're supposed to become restrictive and bring it back down to 2%. So see, it's a symmetric. Before Powell changed it to symmetric, um, because that's a more recent addition. It was just one-sided. So they would go for 1%. They would go for undershooting inflation. Um, but then they've changed it recently to be symmetric 2%, and so that is a big change. A lot of people expect them to change it to 3% as their target. I don't think that's going to happen. Maybe some other central banks might do that, but the Fed, I don't think the Fed will do that. The threat is deflation, hyper deflation, a spike of deflation. That's the real threat here to the economy. Okay, let's continue. The committee seeks to achieve maximum employment and inflation at 2% over the longer run. Longer run is also in a recent addition. So instead of immediately trying to bring it up or down to 2%, they're going to like average it out over the longer run. If it runs at 3%, but they foresee in a couple years it's going to come back down, they might not do anything. Okay, so over the longer run, they want to average out 2%. What is that longer run? Nobody knows. They don't know. But lags, whenever you start talking about lags and stuff like that, it's just uh, coded language for we don't really understand what's going on, but there's a lag. We think there's a lag. Uncertainty about the economic outlook remains elevated, and I would say that's true. One of the things I've been pounding the table about is the PMIs. A lot of people in Bitcoin and kind of alternative macro space, they have been talking a lot about PMIs and liquidity cycles, talking about PMI as liquidity. I like that idea, but I'm not 100% sold on it yet. But I do like that idea. Let's bring up that chart. Where do I have it here? ISM PMI. Share this tab, and I will share this with Telegram as well because I know you guys can't see that. Okay, so we got an update here for November's PMI. It was down at 48.2, down from 48.7 in October. My analysis is this was my case, this red line, slightly up, slightly getting better, slightly improving, but really sideways. That's the base case. This is it's stretched out too far, but you know, probably for all of 2026, something like that. That's the base case. If we do start having reacceleration in the economy, you expect this to come up, and it'll probably come up relatively fast. If that does that, then that's very, very bullish for Bitcoin. You can see that this cycle is visible here as well. And we are in a very weird place right now because we have, is it 34 out of 36 months have been negative in contraction here, below 50. First time ever since 1948 we've had anything like this going back the whole time. It's usually much more volatile, much more up and down, favoring expansion over contraction. But right now we're in this weird spot. So this kind of, are you bullish or bearish? Because bullish for the US economy would be up like this, up for Bitcoin, up for stocks, all of that. And of course, bearish would be a deeper recession before we go up and recover with QE or with some sort of stimulus going on. Okay. So that those are the two different kind of paths, kind of options we have. But the base case for the next 6 to 12 months has to be continuation of this weird economy, which I'm not very happy about. Uh, there's very little to go on historically in this type of situation, but that's what we have. So that's the PMI. All right, let's go back to FOMC and let me comments. Telegram, do you have any comments? No comments. Okay, let's keep it rolling in. The committee is attentive to risks to both sides of the dual mandate and judges that downside risks to employment rose in recent months. Okay, this is important. Uh, for much of the year, much of the last, say, I would say 2 or 3 years, they were saying that the risks were in balance. So they didn't want to necessarily cut rates because the risk of inflation, quote unquote inflation, it was just as risky of inflation as hurting the job market, being too restrictive and hurting the job market. So now they're saying openly that the downside risk to employment is more important to them. Hence why they're becoming more accommodative in their mind and cutting. All right. In support of its goals, we read that in considering the extent of timing and additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data. As they say always. Let's see. Assessing appropriate stance, the committee will continue to monitor implications compared to monetary policy. They did not say anything about their QT or QE. So they have stopped QT, quantitative tightening, December 1st. And they are also doing a little bit of a twist. There's a helicopter flying over. They're also doing a little bit of a twist. So they're letting more mortgage backed securities roll off, not replacing them, but they are replacing the treasuries that roll off. And so they're going to be on net buying more treasuries. So on net, it's just going to be a small amount, but they are going to be on net buying more treasuries right now. So it's kind of like a QE in a way. Um, but the next facility, whatever they decide to do in the next crisis, next liquidity crisis, I don't think they'll call it QE. I think they're going to come up with some different name for it. Um, yeah, like the loan term funding program. So do some other facility that they're going to put out there that is going to act like QE, but not be called QE. All right, so that's that. Let's see how the markets are reacting. So go back to the chart, share this instead, and then go with Telegram, back to the chart. Okay, so that's PMI. Let's take a look at Bitcoin. How is Bitcoin responding? We're going to go down to the 15-minute to get some reaction here. So it looked like the initial reaction was we had a dip and then finished higher. We will see how the day ends up here. A lot of people were talking about the previous cuts. So if we go back and look at the last two cuts, I put them on the chart here. So this was, yes, it did mark a little local high, starting the formation of this horizontal trend line. This also marked a local top going back in September. But if we go back to 2024, because we had the same sort of rate cutting in 2024, except for we did have 150 basis point cut. Um, but you can see that same pattern is not here. They actually went up with each cut. So they cut here and it started going up, cut here, really surged up higher here in the November cut. But this December cut did mark that local top. Bitcoin did eventually go higher, right? But that was a local top, a big one there in December, one that we are still now below on price, which is one reason why the market is kind of struggling right now. It's that. Let's take a look at some other reactions. Again, let's go down to the 15-minute. So the dollar weakened. I don't think this will last. I think this will reverse. The Fed cutting rates is actually positive for the dollar because what it does is it's supposed to be stimulatory, supposed to be accommodative and stimulate the economy. And so when that happens, you need more money to facilitate um, business, to facilitate transactions, and all of that. That's why we see it contrary. It's very counterintuitive, but we see this with the euro and the dollar. When the central banks cut rates, it actually strengthens the currency. So, for example, when the Fed paused after the December cut last year, the dollar weakened dramatically um, relative to the euro, but the ECB continued cutting. Right, the ECB continued cutting in early 2025 when the Fed had not did not continue cutting, and the euro rallied. So that's counterintuitive. You would expect lower interest rates to promote quote unquote money printing or quote unquote inflation and weaken the currency, but that's not the case. It actually is a relative stimulant to the economy, and so you need more money to facilitate that. So this should reverse here. The dollar really struggling with that 100 mark to get above and stay above 100 on the dollar. I think it will, but it's just a matter of time. We've talked about this on recent live streams as well. If you guys want to find all of my content goes out to the Telegram group. That's my main place where I hang out all day, where I'll do Telegram exclusives. I like just doing Telegram exclusives, but I will live stream on the other platforms. So make sure you join that Telegram community and hang out with us. Okay, let's keep it going. So that's the dollar. How about US 10-year? So this one was, if I go out to the daily, you can start seeing some of my drawings here. So these are the last two cuts marking local bottoms. The market giving the Fed the benefit of the doubt and then deciding that no, it didn't work. Maybe it's just an early move here. It did obey. I did do what I was predicting up until we headed into December. And it did rally here. Not really it did make a tiny bit of a new high for yields, but nothing really significant. That was just a little wick up there, and now it's a down day. So we'll have to see how this develops. Of course, if this continues to go higher, that's actually a positive sign for the economy. That means growth and inflation expectations are rising, which is good. Um, and that should benefit Bitcoin as well. Bitcoin should be able to rally in a naturally occurring rising and steepening of the yield curve. However, if we go to the 3-month, let's see where that's at. That has dropped just 1 basis point. And if we bring up Fed funds, you can see this has come down into this new, came down early, come down into this new range, but we will see how this goes. Let's take a look at SOFR, something that we've been watching. Yeah, not showing a ton of stress, but it is hanging out at the top of the range. And we'll see how fast it can come down into the new range, because the new range 375 to 350, we have to see how that develops there. Okay, so back to some other charts here. How about gold candle? We'll go down to 15-minute. Gold like this, but I think this will reverse as well. I don't think there's much energy right now in gold. It could make a new all-time high, but I think it'll be marginal. I think it's close to the top. Okay, how about oil? Oil going up slightly, but guys, it's still under 60. I think I'm the only person in macro that called this pretty much dead on oil over the last few years. And I just don't see any real marginal demand to keep it up. You can see looked like it was breaking out of this downtrend and it's right back in. We'll see if it can break out. But long term, guys, there is the demand for oil isn't looking good relative to supply. The world is in an oil glut, and it probably will continue to be in an oil glut for the next decade. Um, so long term, we're looking at cheaper oil, or even just staying around 50 or something like that. But I do think we're going to hit 50 perhaps in 2026. All right, and stocks, let's take a look at that before we go. 15-minute. Oh, we got 5 minutes till the FOMC speech press conference. So reaction here to the upside. Nothing too unexpected within daily trading range. So yeah, it's nothing too exciting actually as in a reaction to this. This was priced in, obviously. A lot of people were expecting this, and we'll see what Powell has to say when he comes up for the FOMC. So let's go there now, actually. Got the FOMC up. All right, let's see. What are you guys thinking out there? Put some comments down below. Telegram, what's going on with you guys? Did a spaces this morning for bitcointreasuries.net. The big ones are on Fridays, so make sure you guys join me Fridays at noon, bitcointreasuries.net on Twitter, and join us for the spaces on as many big players as we can on those Friday ones. And then we'll have smaller interviews and smaller hangouts on different days of the week. But yeah, we discussed, what did we discuss this morning? MSTR. We discussed MSCI. They're trying to delist MSTR and what it really means. We kind of boiled it down to it's a small player. It's kind of an isolated player right now. BlackRock, Vanguard, JP Morgan, all the big banks, like 8 out of the 10 biggest institutions in the world, financial institutions in the world, are diving into Bitcoin. It might be 9 out of 10 now. I'm not sure, but all these people are getting into Bitcoin. And the only player left that's really fighting this, it seems, is MSCI. Their listing isn't that big of a deal. There's some passive flows that go into it, but Brian Hirschfield was on, and he was talking about how it is really mainly the foreign indexes that are MSCI's bread and butter. So you would invest in, if you're an American, you can invest in like European or Asian indexes. And that would be what MSCI, their big thing is. So that's not really going to affect much of MSTR, but I think it is a real threat. And we kind of left it saying that we think it is a real threat, that they really want to delist, and we will see. They're isolated, like I said. Michael Saylor's trying to push back. So if you guys can go and sign that community support, show your support for MSTR, that would be good. Okay, Spock, you said just in Federal Reserve to buy 40 billion worth of treasury bills over the next 30 days. Okay, do you have a link for that? That sounds like QE, but there was no mention of QE in the drop. there is the end of QT now. So if they're saying 40 billion of mortgage-backed securities are rolling off, then yeah, they would be replacing that with treasuries. But that seems like an awful lot of mortgage-backed securities to be rolling off. I think it's probably about 10 billion at the most. Oh, yes, green. So that would possibly counter the EU's treasury dump threat. Yeah, we talked about that this morning as well, or on the space. It was actually at noon today. Um, and the threat is kind of a nothing burger from the EU. One, my take is that, you know, the global financial system runs on repo, and you have to have US treasuries to be in repo. I mean, you could use German government bonds, but there's just not very many of those. I don't think you could really use JGBs because they're crashing in value right now. Um, your haircuts would be extreme. So there's not really many choices to use in repo except for US government debt. And so if they do that, they're going to cut themselves off from that repo market. They're going to face a liquidity shock. I don't think they can actually do it mechanically. I don't think they would be allowed to do that. But who knows? Who knows? My haircut is extreme. There's also other considerations like the pivot of the United States towards stablecoins. It's slow, but it's going in that direction. Um, and stablecoins are going to be big buyers of U.S. government debt. Isn't Tether already like the third or fourth largest? Okay, here we go. Powell's up. Make sure that's coming through everywhere.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of.
Okay, Dex, what's Did I lose it? No, I'm back. Okay, there was a whole prediction market on what he was going to say in the opening. Good afternoon or hello everyone or something like that. Good afternoon, one.
Maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our
Again, we covered this. He's right, but he's right, but I don't think he's being completely honest. It's not completely honest.
our goals in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing.
I didn't see that. Sorry, I'm just looking at the statement. Okay, guys, here, this is why we missed it. We didn't read far enough. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis. Okay, they snuck that in at the end after all the boilerplate. This is boilerplate. They snuck that in at the end. Algos probably caught it. But this is what do I want to say about this? Um, this isn't 40 billion. They don't say a specific level, but we will see what he says here. Shorter term securities. So this is interesting because that's talking about probably bills, T-bills, 1 year and under. That's not good. Those are the most liquid and most pristine. They had this. They did this problem back in 2019. Was it 2019? I think it was 2019. And they were buying bills, and they thought this was good. This was going to support the market. But really, in a liquidity crisis, you need more bills. One of the things they've been doing, the Treasury has been doing recently with this kind of the buyback operation twist, is they've been issuing longer securities and buying back issuing short-term securities and buying back long-term securities, trying to up the share of debt that's short-term. And a lot of people are talking about this because when it comes to interest expense, so on when rates are rising, that's kind of not very smart because you're going to have to roll that debt over at higher rates, and you're going to be paying higher rates. But if you have a higher percentage of, say, 10-year, 20 or 30-year government debt, you don't have to roll that over as often. But when yields are falling, that can be a benefit because you're rolling over a lot of that stuff really quickly. But short term, this could be a mistake. We'll have to watch this develop. I'll see what Jeff Schneider has to say about this, Nick Bhatia, because I think they will also pick up on this, that could pose problems. Okay. Like, comment, subscribe.
Reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in.
Tell me how the volume is, guys. Okay, so 1.7% this year. We just looked at the GDP now, and it's at 3.8 for the year. And well, that actually 3.8 for, let me double check, for the quarter, 3.8 for Q3. Looking to see if they have a yearly one. So yeah, okay, that's where the disconnect would be. But let's look at this projection. Okay, so 2025 down here at 1.7, then a rebound above 2, and then flatline to 2. Of course, you guys know that I make fun of this every single time because it's like nobody sees a recession coming. Not a single member. So these range of projection bars here. So that means that all of the members' projection was within this range. Nobody sees anything down 1 or 0. Like nobody sees a recession. It's like groupthink to the extreme, just 2%, laser eyes to 2%. It's not really analysis. This is not analysis. This is wishful thinking. And then since they all have a goal of 2%, all of their wishful thinking aligns out to 2%. very little information on this. Okay.
September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months.
Less dynamic, that's his way of saying weird, like I've been saying.
In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter.
Okay, let's go back and look at that.
Well, in this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our
I'm having to adjust my volume. Sorry about that, guys. Still working on this new mic. So, unemployment rate. Let's see. You know what their projection looked like for this spike? It was flat too. I mean, so 2025, they think 4.5, and somehow magically it's going to come down, even though the risk is to the upside. And they are, I guess, addressing it in their minds by cutting rates. So they're cutting, I guess, enough in their minds to keep this unemployment from picking up. But remember the SOM rule. This is the first time ever that it hasn't triggered to a major any sort of recession, and so I think that there's still a risk out there for end of Q1, end of Q3, 2026 to be crunch points and to have something happen. I don't think we're going to get out of jail free card on this. They are already talking about stimmy checks, not like straight up from um, from new debt or anything. They're actually going to finance it through the tariff revenue that they're bringing in. They talk about lowering income tax and going more and more towards tariffs, which is, I love that idea, but how viable it is still unclear. And that's those stimmy checks will come from the tariff revenue, $1,000 to $2,000. I think that we will see a drop in inflation as well, so that will help the average person. But unemployment, we will see. We will see. Again, this is groupthink. This is the best case scenario almost, and they just, of course, the error bars, the range of prediction is very low, very tight, and of course, 4%. That's what they see.
Our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year.
look at how tight. Sorry, I got to do the volume. Look at how tight this is out here, 2028 in the longer run. You can't even see the projection range. That's pretty much just giving up. That's giving up on making a projection. Um, yeah, it's right. I mean, to me, this is not valuable at all because I mean, there's a few people maybe here in 2026. There's some uncertainty, but really it's between, it looks like about 2.1 and maybe 2.6%. Like that range isn't very big. I think there's a chance you with all of these voting members or members that put in these projections. I don't know exactly. I think there's 12 people maybe that put in these projections. Um, Out of all of them, none of them see any sort of downside risk at all. That's pretty troubling.
And 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for.
Okay, we can. Sorry, guys, got just the volume there. Okay, so we can take a look at the SEP. You can, and let's make sure I'm sharing this. No, share this tab. I think Telegram sees it. Okay, so this is the FOMC calendar, and you can see over here they have these projection materials, and that's what we want. Going to come in here, and I wanted to see the Fed funds rate. So 2025, their predictions with 3.6, okay, right in the middle of where they're at, of course. Same as the September projection, the last projection that they had. They're projecting right now for 2026 to be at 3.4. Okay, so that's one cut. They're expecting one cut in 2026. And that's also what they had last time. In 2027, all the way down to 3.1. So that would be 2 more cuts, right? That would be 1 more cut in 2027. So 1 cut in 26, 1 cut in 27, and no cuts in 28. That's what they're thinking. And no cuts longer run. So that is their neutral. What they are considering neutral is 3%. Crazy. But man, okay, let's go back to it. That's what they're telling here. That's what we're looking at here is the dot plot. The average of this is what we're looking at. Let me make sure everybody's seeing this. No, we want this one. Okay, everyone's seeing this. All right, let's go.
For the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels.
Okay, here we go.
Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month. And
Guys, I freaking called it. Reserve balance purchases. Is that what he called it? Reserve management purchases? Oh man, now we got to rewind it.
As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to
Reserve management purchases. So that is QE. They're starting QE right now. What? I told you they weren't going to call it QE. They're going to call it something else. Reserve management purchases is what they're going to call it. I think I wrote about that. On Rogue and Bitcoin and Markets on the last premium post, or maybe 2 premium posts ago. I talked about that the next QE is not going to be called QE, and they're probably going to come up with a term for it. What was it? Reserve management purchases. Now I want to look that up. Oh man. Okay. Reserve management purchases. I want to know what I called it. QE returning. Okay, here we go. So this is from November. This is 1 month ago, November 12th. It went out both on Rogue and Bitcoin and Markets. The premium tier is the same for both of those guys. But here we go. QE returning. At the last FOMC meeting, something I pointed out during the live stream, and that has been picked up recently on macro Twitter, is Powell pointing out that QT would be coming to an end at some point in the future. It would be appropriate to expand the balance sheet. This is juicy for inflationistas because the Fed increasing its balance sheet is instantly interpreted as inflationary. We know here that it's not. The Fed increases the balance sheet when the risks are toward a deflationary outcome. Wow, so they're worried. Powell's reasoning is guided by the misguided principle that the Fed's balance sheet must grow along with the size of the financial system and economy. Shrinking the balance sheet naturally through roll-offs, or QT, were to bring the balance sheet into what they view as a neutral position as a percent of total bank liabilities. So they think they need a certain amount of reserves to have a functioning liquid financial system. Okay. banking sector, financial system, whatever you want to call it. Even though before the great financial crisis, that never happened. Okay, that was not the case. George Gammon points this out, that there was only like 800 million, I mean, not even a billion, I don't think, of reserves held at the Fed prior to the great financial crisis. And now all of a sudden they need to have these ample reserves at the Fed. It was a new idea that really hasn't been proven. I mean, it hasn't been proven in any way, shape, or form. It just has some academic papers now probably around this idea, but really there's nothing to back it. Stand by. All right. Okay, where was I? Too small of a balance sheet risks too small of a balance sheet, risks will build in the system. Too large of a balance sheet means they put too much money out into the market and it will overheat. Ending QT is a statement that the Fed believes they are in this neutral sweet spot. As the economy goes forward and hopefully grows, that neutral amount to keep as a steady proportion will also grow, meaning the Fed will have to add to their balance sheet, not in an accommodative way called QE, but in a neutral way as a sort of market maker. And here is this image that I pulled. So from the Bank of New York, talking about um, this is the percentage. So see, the percentage would be too low. Anyway, you guys can look at those charts. When the Fed freezes the level on December 1st, we will be forced to buy treasuries to replace those that are maturing each month. Then, when they expand the balance sheet again, they will buy even more each month. The name will be different than QE. Boom, right there. Reserve management purchases is what they landed on. And what did I say back 1 month ago? Reserve management facility. I called it the reserve management facility or something similar. And they called it the reserve management purchases, not QE, but that's what it is. And I called almost exactly the name of it. It is possible we move into Q1 next year. The Fed will start up this new QE facility. It happened much earlier, but we're getting close to Q1, right? We're only 3 weeks away from Q1. A low-level maintenance amount would be 10 to 20 billion per month. This is my baseline expectation right now, which should be relatively bullish for Bitcoin. So this is very bullish for Bitcoin. If it's 40 billion, like Spock had put in the chat, this is going to be very, very bullish for Bitcoin. Of course, if the economy deteriorates prior to this facility being created and being the reason the facility is created in the first place, this would imply Bitcoin taking a hit beforehand. Okay, so that I dudes, I called this exact name. Reserve management purchases. I mean, I said facility, but they said purchases. Wow. Okay, so that's where we're at. Make sure you guys are subscribed. That's the pro tier over there on the website. Okay, let's make sure everyone's seeing this. Now let's continue this. Let me volume. Sorry for having to adjust the volume, but I'm not hearing him very well, so I had to turn it up. But then I feel like I'm talking very loudly with the new mic. So I had to balance it back and forth. So sorry about that.
$40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets.
Spock, you were right.
Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated
Sorry. Look at this room. What's this guy thinking right here in the middle? Huh? What's this guy thinking? Texting, guys, reserve management program or purchases. Her head is down. You know what this could be? You know what this could be? Let's go to the charts and I'll fix you here. Telegram. There we go. SPX liking it right now. Reserve management facility. QE is back, baby. Bitcoin. Let's see the dollar. Dollar probably doesn't like it. Gold. Gold liking it. Exact reverse. Wow. Wow. Okay. Okay. This is what we got. How about stocks? Stocks are really liking it. Wow. Okay. Reserve management purchases has entered the building, here. But what I wanted to take a look at was this one. If we go to SOFR, and it doesn't have that, it's a daily. There we go. And if we bring up the Fed funds, we've looked at this quite a bit over the last month, haven't we, guys? We started looking at this, really when probably this one was spiking, and Nick Bhatia of the Bitcoin Layer, he was getting really kind of focused on this. And we talked about this just on the last live stream. Was that Monday or yesterday? I can't remember now, but look at how SOFR usually behaves. Okay, it's usually in the middle or bottom of the range, and it has these little spikes at the end of the month before meetings, like a meeting spike. I identified those, but really it's at the bottom to the middle, bottom half of the range. Okay, that's the normal. But something happened here, September 15th. Again, guys, what is September 15th? I mean, that was the FOMC meeting. It was actually, I think, the 16th and 17th was the meeting itself. It was the FOMC meeting, but it's also getting into the end of the third quarter, seasonality. So, bam, there is some stress right here. This is showing stress. Moving into the FOMC, moving into the third quarter, the Fed starts cutting there too. That's not a coincidence either. Okay. Then what happens to SOFR? It's the top half of the range. Something is different. Something is stressful in the economy, and it's breaking out of the top twice here. Cut 25 basis points. It even struggles to get down into the new range, but it stays pegged at the top. Then we had this big breakout that we were watching here, and I was talking about multiple times. And it's come back down, but it's still at the top half of the range. And then they cut today. So again, we'll see where this ends up. But this behavior is probably spooking the Fed. This behavior is probably spooking the Fed because it tells you that there's some illiquidity in the market, in the interbank market, where liquidity matters. And then there's this whole idea of liquidity, defining liquidity. I define liquidity as the smooth flow of capital, both directions. You have to have cash going one way, and you have to have collateral going the other way. And if that's a smooth flow, then that's a liquid market. If it's not a smooth flow, you have illiquid conditions. And it doesn't matter if you quote unquote raise M2. Okay. Raising M2 is not liquidity. That's why I don't like these GLIs and all these other measures of liquidity out there in the market, because they are measuring things like M2, global balance sheets. That is not liquidity. Liquidity is between balance sheets. Okay. And SOFR right here is telling us that something is different, something is more stressful. And I bet this is what is peaking. This is what is causing them to go instantly from QT back to QE. And they're calling it reserve management facility. And by the way, guys, I called that exact wording on my premium content. Okay, let me see. Let me check out some comments here. Dex Invictus, yep. Satoshi. Says BTC is in the process of increasing in 2026. BTC is a reference for increases in a crypto world. Go, go, go. Okay. Okay. Some emojis. Yeah. I mean, I think Bitcoin is not, I don't believe in the crypto world. I believe in Bitcoin. And Bitcoin is, uh, it's becoming a major asset. Like I said, I don't know if I said this when I was going live on all the platforms or just in the Telegram pregame show, but um, all of the major banks now are involved. We have BlackRock, Vanguard, everybody. There's one lone player that's pushing back. They're not even a major player. They're kind of a major player. They're kind of a medium-sized player, and that's MSCI pushing back against the digital asset treasuries or DATs or MSTR. Okay, that is the one holdout here. Bitcoin is taking over. It's getting inside of all of these banks. It's the Trojan horse moment. Okay, they've come to the gate, and there's one player left saying, no, 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 don't bring that Trojan horse in here. And that's MSCI. Okay. But everybody's trained on it. BlackRock has a vested interest to push back against MSCI. JP Morgan has a vested interest now. Vanguard has a vested interest now to push back against this marginal player of MSCI. Michael Saylor put out this uh, response today and saying everybody go and tell MSCI that show them your support for strategy. And I'm sure thousands of people did it. I tried doing it. I put in my email and there was a problem. I don't know if it was overloaded. The website was overloaded at that moment, but I bet thousands, maybe tens of thousands of emails are going to MSCI's way. And this is a huge show of force, a huge bullish show of force for Bitcoin. And Larry Fink and Jamie Dimon, even though he doesn't want to be, they're on Bitcoin's side. So Bitcoin is moving into these banks, moving into mainstream. And if you get a 2% allocation, a 5% allocation to Bitcoin, it is game on. And now we're getting into rate cuts and QE from the Fed. This is QE. They call it reserve management purchases, but it is QE. And I called it. I said they're going to call QE something different. And so this is what they're scared of, I think. SOFR right here showing that there's some illiquidity in the system. This illiquidity will manifest as this type of spike in SOFR, as a dollar shortage. So we should start seeing the dollar start ticking higher. Okay, so that's that. Let's go back to Powell. Guys, like, subscribe, retweet, all of that stuff. Make sure if you're watching on Twitter, jump over to the YouTube, subscribe to the channels over there. I'm going out both on Bitcoin and markets and Rogue Macro. Rogue is kind of my new brand for macro stuff, and Bitcoin and market is my legacy podcast content for Bitcoin. But right now I'm going out on everything. Also, the Telegram, check the link in the bio. Make sure you join there. Okay, let's keep going with this. And again, sorry for the volume, but I got to turn it up and down.
Employment and price stability goal.
Sorry, guys, I was sharing the wrong tab. Test, test. Okay, there we go. Sorry, I was sharing the wrong tab. He's just wrapping up. He didn't say anything else about it. Let's see, point. I swear the exact 40 billion was floated a few weeks ago. 40 billion, I think, was the end of what they were doing for QT, or that was the last major level I remember. They might have been down to 20 billion, but 40 billion, I didn't hear that for this QE, but this new QE is 40 billion.
Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to.
This is a good question. I like how he phrased that. The risk management phase. So, they were cutting because the balance of risks, and the balance of risks were towards higher unemployment. And now they're asking, is this preparatory phase done? And are you going to be waiting now for something to change, right? Have you reached neutral for now, and something needs to change again in the incoming data for you to continue? Or because there is that feeling, especially with the QE coming, there is that feeling that this is now a new kind of steady state that they expect to go on for a long time. And just look at their dots. Members of the FOMC are expecting to cut one time in the next 2 years each. So that does seem like a new pace, a new phase of their monetary policy. They're signaling the end of these type of consistent rate cuts that the market was pricing in, that the dot plots were pricing in, that all of these other things were expecting. And now this is a new phase. So I think this is a good question. I just want to hear him talk about the what is it? Reserve management purchases. But okay, let's go.
We get a great deal of data now in the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down, and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but putting down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. You are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
One thing I'll say about that, those were okay questions. Nothing fantastic. Nothing special said there. I just, they keep harping on these tariffs, and look at the year over year inflation rate, or CPI. Year over year CPI is showing that this is, tariffs. What's the baseline of tariffs? Wasn't it 25%? I mean, it's all over the board now. Some are 10%, some are 25. But the tariffs, I mean, we're sitting at 2.8 on PCE and around the same on CPI. Uh, how did, you know, where is this pass through of tariff prices? There really hasn't been any. I mean, maybe you could say half of a percentage point or something like that, but on 10% tariffs, 25% tariffs. So I don't know. I don't like bringing up the tariff thing because it's so obviously wrong, and it's been so obviously wrong this year. But a few things he said there, that the risks are more towards the downside, that they think they're going to be able to cut, or that they're going to cut next. They're not going to be raising rates next. So that is some forward guidance for you. Um, she said something else about the dissents. I don't think there was anything special from that question. I would just say that, yeah, the big takeaway from Timoros's line of questioning was that nobody is seeing rate hikes. They're only seeing rate cuts in the future. That leads me to believe, they think we're going to have this no landing situation. And if you guys go back 2 or 3 years, and we're talking about this hard landing versus soft landing versus no landing. So what do those mean? Well, a hard landing is when the economy crashes, okay? When we have a significant recessionary event, a liquidity crisis of some sort, and you have a hard landing, unemployment spikes, etc. A soft landing would be just a mildly bad economy, nothing too bad. And a no landing would be nothing really happens. We just chug along. And right now we're kind of in this, I don't know, a little bit between a no landing and a soft landing, because if you go back and look at the PMIs, they are in contraction. Okay. Our economy is in contraction, even though our GDP is rising. Most of that is AI capex, not actual production. It's just spending on AI. But really, we have this, I'll say it again. We have this weird period of like very mild deterioration. That's what it is, feels like. Okay, how long can this go on? The next, if he's saying it's going to continue, he's saying the market that we have right now is they expect it to continue for the next couple of years, at least in their SEP. They're going to cut once each of the next 2 years. This market is just going to continue like this. But then, of course, there we have QE starting now. So how does this all fit in? It seems like the addition of QE is saying that they're worried about they're worried more than they're letting on about liquidity. So there's some thoughts there. Okay, let's continue. Let's see who's going to ask the first reserve management purchases question.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? You know, I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. You know, in terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that this is that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. You know, do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, you know, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say
First one.
concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in reserves, in an ample reserves regime. So, you know, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, you know, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, you know, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month.
Whoa.
So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Sorry again about the volume, guys. I had to switch it because it's really low on my side. I hope the volume of Powell is okay for you guys. Okay. So that was the first question there of the ample reserve program. I will remind you guys on the pro tier, I wrote about this and predicted pretty much this exact name. Share this tab. Reserve management facility is what I called it, but they're calling it reserve management purchases. It is QE. I said that a low level maintenance amount would be 10 to 20, and he just said 20 to 25. So I was in the ballpark on this low level maintenance, and that is QE. It is QE. It's raising the balance sheet of the Fed. It's asset purchases, reserve management purchases. And he talked about, why they're doing it right now and yada, 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 trying to play it off. But make no mistake, this is the return of QE 6 or 7 or whatever we're on now. That's what he's saying. So that was the first question in that regard. Let's see if they say anything else in the next couple questioners, and then I'll call it a day, guys.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussant. I'll give you a mulligan, though.
No, thanks. I don't know if that means I get 3 questions, but
no, just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our 2 goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the 2 things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really, but it just tells you you've got to. And I think ultimately what it says is when they're broadly equally threatened, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I want to see if I could address sort of the elephant there. And the president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation, as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing the costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria. Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2%?
That's a dumb question, so we're not going to listen to that. All right, guys. Let me check for comments. Spag says he stuttered a lot on that one. Yes, he did. You're probably talking about if he has a comment about the Supreme Court case. I mean, guys, Trump is 25-2 at the Supreme Court. Is this Lisa Cook stuff going to be any different? I mean, the big one that was just the other day, let me go to a different screen here while we're waiting, while I'm just chatting. We will go to Bitcoin chart. Okay. Make sure I'm sharing that with Telegram as well. So the arguments had just happened yesterday, and they were all over Twitter, and I subscribed to what's his name on YouTube? Robert. Gosh. Begoya or something like that. He's a attorney down in the Phoenix area. And so he was listening to the Supreme Court and commenting on the Supreme Court stuff. And that case is about the FTC, one of the FTC employees. I don't know if it was the commissioner or one of the top people, but he tried to fire them. And then they're saying, oh, you can't fire us except for cause. And that the Trump didn't cite any cause in the firing, but this is there's nothing in the Constitution that says he can't fire an executive member of the executive branch. They serve at his leisure, and everybody should know that. And that is the strict reading of the Constitution. And so there's a fight right now in the Supreme Court over these independent agencies. Okay. And it looks like according to the questioning that was going on yesterday, the oral arguments at Supreme Court, it looks like it's going to come down about 6-3, upholding Article 2 powers of the president to fire these independent agency, quote unquote, independent agencies. They're really a part of the executive branch. You know, they are executing the laws of Congress. The pushback, okay, the way that you would rein in the president's power in this degree is not by suing and using Article 3 courts. Okay, that's the Supreme Court is Article 3. You have Article 1 courts as well. Those are like the district courts. You don't use the courts to push back on the president. There is a constitutional remedy, and that is impeachment. Okay, so you have to impeach the president to stop him firing these independent agency heads, these commissioners. That's the constitutional way to go about it, from my understanding, and that's probably going to win. All right, what does that mean for the Fed? Well, the Fed is kind of in a unique position. They did bring it up in those oral arguments. The Fed is kind of it's unique. It's 50-50, right? It's not like this. The FTC is 100% government. We know it's 100% government. It's not a fourth branch. It's in the executive branch. Okay. But the Fed is unique because it's 50-50. It's private with government oversight. And so does that mean that Trump has the ability to fire Powell, fire Lisa Cook, fire the governors? And, that's what's kind of up for debate. And I don't know if I know there's the Lisa Cook case that must be coming up next month in the Supreme Court. But if he wins this FTC thing, he's probably going to win the Federal Reserve thing as well. And Powell could be gone very soon. What does that mean? Well, probably all these dot plots and all these other things, those are going to be moot at that point, because this Kevin Hassett will come in and he's going to be cutting rates like crazy. At least another 100 basis points, I think, in 2026. Okay, so there's always that little fly in the ointment as well. But I think I'll leave it there. Let me check and see if there's any other comments coming through. Nope. Thank you guys all for joining me. Let's take a quick look at the charts here before we leave. And Bitcoin trying to push up. Let's see how gold trying to push up too. This is hours. We'll see how that develops. The dollar should strengthen from this, but if they're doing QE now, this is going to put another little hiccup in the market digesting this data. So we could see this move continue the rest of the week and then only reverse in coming weeks, right? Because like I said, on the 10-year, if we look at the 10-year, what I said was that this is giving the Fed the benefit of the doubt, take some time to digest, and then, okay, now it's coming back down. Give the Fed the benefit of the doubt, take some time to digest, and then come back down. I don't know what this part exactly is. We'll have to wait and see where this goes. Really, like Powell was saying there at the end, that the market is, it's not like we say that long-term bonds are growth and inflation expectations, but the inflation expectations are relatively low right now. So that means that this move is a growth expectation move. Don't know whether that has something to do with peace talks with Russia and Ukraine or other thing. I don't know. Again, we'll have to wait and see, but this is pretty much a growth expectation thing. That's what's pushing rates higher. Some economists, some macro pundits out there think that yields going up is bad for the economy. I mean, it might be bad for the U.S. government paying their interest, but it's not bad for the economy. This is a good thing. It means that people, it means one, incomes are going up because yields are somebody's income, right? Two is that people can afford it. All right. if people couldn't afford it, there would be no demand for those loans at those rates, and they would have to lower yields. They'd have to lower yields to attract people to take out loans. So yields going up means that there's profits out there to be made. Now, will this go up dramatically? I don't think this can go up to 5% or anything like that. I don't think we're in any danger of that happening. But it might just take a while longer to come down. We'll see into, middle of next year. Like I was talking about, my base case is sideways to up for pretty much all these assets that we talk about here for the next 6 to 12 months. And then what does that mean for the 10-year? Well, it can be sideways to down for the next 6 to 12 months. So I'll have to update my analysis there. But okay, how about stocks really rallying here towards the end of the day? And lastly, on Bitcoin, one last time checking for comments. No comments out there. So we're going to end it for today, guys. Thank you so much for hanging out with me. Make sure you like, comment, subscribe, follow if you're watching on Twitter. And check out Substack or roguemacro.substack.com or Bitcoin and Markets, the pro tier, where I did predict, guys. Let me share this one more time. This was pretty incredible, in my opinion. I was trying to come up with, they're not going to call it QE. So what are they going to call it? All right. I wrote this back on November 12th. I said the name will be different than QE, perhaps Reserve Management Facility or something similar. And it came out as Reserve Management Purchases, almost identical to what I had predicted. So, all right, guys, thank you so much. And I will see you on the next one. Bye.